Well, for what today's news all means for debt capital markets, we're joined now by Todd from FIIG Securities in Sydney. Mark, good to see you there, and great timing after we've just heard about the NAB cutting its floating mortgage rate by 20 basis points. Do you think now that we're going to see the other three major banks follow suit?
I think, NAB's taken divorce to its new highs. It's had that program where it wants to divorce itself from the other banks. And so they'd be quite annoyed right now up in Martin Place and in Melbourne. It would be clear that the NAB's thrown down the gauntlet, and I think there's 2 points to that. One is the fact that they might actually believe there's another rate cut coming, so go early, take as much of it as you can into the client base, knowing that you might be able to make a better story with the next one that will come. And the other point to remember is the cost of funds to them via the international markets is getting cheaper as they become recognised, with all the banks are becoming recognised as very good and safe havens for some of these investors, so they're able to generate some long-term bonds in the 5-year bucket at good rates, and they'll be able to make some nice margins on their mortgage book. But to your point, there'll be three banks out there kicking themselves and kicking the can and saying it'll be hard to justify a circumstance where you're less than the 20 basis points, and it'll probably need a marketing machine that's not evident in all these banks of late on how the cost of funds have become harder, and so they won't pass that cut on. So I'd imagine they will be reluctant, but they'll probably get very close to that 20 basis points.
Are you surprised that the NAB went with 20 basis points? Did you expect it to come in less than that, or perhaps to pass on the full 25 basis points?
It is surprising that they went as far as they did in terms of how much they pass on. I mean, the banks haven't been notorious for being gracious with some of these rate cuts, and they've been able to make cases around how it's very tough, and they've tried to make the case that it's hard to fund the bank in the present circumstance with the volatility around Europe and North America. So it is a surprise they've gone as far as they have, but you could see some business logic around the marketing. Everyone will be talking about it. It's Friday afternoon. It'll get good press tomorrow in the weekend paper. It makes a lot of sense from a marketing perspective. So the 5 basis points you might have given up, in other words, try to keep 10, you'd probably spend in marketing anyway, so you get that free kick along.
Apart from ANZ, which we know now holds its meeting next Friday to decide on interest rates, are we going to see the other two, Westpac and, of course, CBA, come out this afternoon now? Will they have to act quickly, do you think?
It'll be hard to tell what they'll do, but it makes some sense, doesn't it, in terms of the NAB's going there, and you don't want to be seen to be reactive. You want to make it part of your normal business activities, and you might be saying, well, we were always thinking that at the end of business we'd advise our customers as to what the next rate will be. So you could make some business logic. If you come back on the Monday, it's a slower news day by its very nature. You don't have that weekend push. So it would be hard to understand why they'd want to wait if they were going to make that decision. That's a call made by, there's a few executives that will make that decision. It's not like we go to every branch in the country and ask what do they think. So you think, logic would say they could get those executives together, they could make a decision on where they'd want to go if they were going to go 20 basis points. If in the effect that they aren't going to go the 20 basis points, they might wait till it's a quieter day and try and, slide it under.
Okay. Can you just paint us a bit of a picture of the current wholesale funding environment and whether there really is no excuses now for these big banks to pass on the rate cut in full or the majority of it, given that the funding costs seem to be lowering? Well,
I think it's a broader macro conversation, but the point is that in North America, when they decided with QE3 to extend that zero cash rate out to 2015, that meant there's a lot of money around where people are looking for some sort of return. So when the Australian government has issued bonds and that's been very well bought, you look to move up your risk parameters, and you look at the four major trading banks, and it makes some sense to be able to, as an institutional investor, to be able to buy their paper at competitive yields, and which is in the 4s and 5s. So it's very competitive returns for you compared to where the government bond curve is and where the US curve is. So it would make some sense that credit's moving tighter. In other words, the banks are paying less for their money, and they're getting a very competitive spread onto where they put the mortgages out. So a lot of money is still lying on the sidelines looking for a home, and Australia, with the sort of growth we see as a GDP, the sort of economic numbers we have, whether it be employment and the broader safety of these four banks, they're heavily regulated, they're very safe institutions. As an institutional investor, I would want to try and put my money with them where possible.
In terms of the impact this is having on investors, Mark, we've seen a real return to chasing yield this week. The banks and the consumer discretionary sectors doing very well. Do you think that this is going to continue now we're in an environment of lower interest rates?
Well, you know, the challenge is for the term deposit world, where we're talking to our customers, we're suggesting that the best thing in the term deposit is to extend your duration. Previously, what most clients look to try and do is invest for a short period of time and move around and look for more attractive rates when banks were having a tough funding environment. And what we're saying now is it makes some sense to go longer in the 1 and 2 year part of the curve to take advantage of what now seems to be historically or retrospectively they'll be high rates. If the cash rate's at 3% and you can get 6% in either a fixed income asset or a long-term asset in the term deposit market where it might be 5.5%. These are very attractive rates, and they look to be attractive over the medium-term horizon with cash rates around 0 and our cash rates going to 3%. So we think clients should be looking longer and looking at the spread between the cash rate and your return. If you make double cash rate, that's a pretty good return.
Okay, and what about the impact on the Aussie dollar? There has been a lot of talk this week that we may see it reach parity with the greenback sooner rather than later, now that we are seeing this falling interest rate environment.
I don't believe that's going to happen. I think the Aussie continues its underlying strength. I think some of your commentators this morning have been talking about the fact that the Aussie just has an inherent, it's the commodity bias, but it's also the high interest rate environment that we have relative to the rest of the world. It's also the type of economy we've got. It's not a Greece or it's not an Italian or a Spanish economy. It will make sense to say that people will look to buy our assets on a consistent basis. That'll keep the Aussie up.
Mark Todd from FIIG Securities, really appreciate your analysis this afternoon. Thank you.
Pleasure.